Jyotivardhan Jaipuria joins in on the show to chat about his take on the markets. Jyoti, hi, morning. How much of a probability are you assigning to how the market is going to behave to the exit poll reaction? It's going to come in post-market hours, but do you sense that this could be a hugely market-moving event? Or do you think for a market which has so much on its hands right now and is going into the exit polls in any case so weak, this could be largely, a 1% move here or there?
Yeah, see, I don't think the exit polls are going to be very material, and the impact of the exit poll probably is like a 1 or 2 day affair, so I don't think it's like that big event. What we have to remember is we are down 10% on the broader market since the beginning of September and probably 15% on the mid caps already. So there have been so many events which have played out that I think for the market probably the concern is more the global markets and how they behave rather than the exit polls itself, unless there's something which is totally shocking from what the general consensus is.
Okay. Right. Aside of that, the other uncertainties, Jyoti, and more so on a global front. You've got the OPEC meet currently underway. We've already seen how sharp the reaction has been, a move of almost 3% overnight, as day one indicated that there is no deal really on production cuts coming in. You've got the Brexit vote which is impending, and then that inverse move that you've seen on the US yield as well. How do you think the market is going to balance itself out? And do you sense that we could see extreme volatility that could stretch out up until maybe the 2019 elections? Are we looking at next 6 months of a bleak zone for markets, or do you think the recovery could come in much quicker than that?
Yeah, so I think it will be a volatile period because of both India as well as global events, because globally, like, you have the Fed which has moved on a path, but at some point I think next year we'll see the Fed maybe not cutting as strongly as the street is anticipating, because the US economy starts to slow down a bit. A lot of it has got fueled by the tax cuts which is there in the base now. So that's one event to watch out for. The second is going to be this whole China-US trade spat, because if it works out smoothly it's great, but otherwise that has the potential to disrupt a lot of things structurally. So I think there are global events which probably could cause volatility. As we get closer to the general election, there will be volatility on that front also. So I think there will be volatility over the next 6 months. For investors, quite often these volatility times are times where they can get into the market, they get cheaper, and that's the time to really buy stocks.
Okay, so what would you look at buying in the markets? There are enough and more badgered names which have been okay from a fundamental standpoint. Names like Yes Bank, Sun Pharma. I know that they are controversies surrounding their business models and the transition, etc. But at the very core, these are still index stocks. What's the approach that you would take to such volatility?
Yes, my view is that, for the last 10 years, we've been waiting for earnings to recover. And at some point now, everybody stopped talking of the earnings recovery. So my view is over the next 3 years, the whole theme is going to be a recovery in earnings. It's going to be a recovery in the economy, a recovery in earnings. And the way I see it, there are a lot of sectors which have already started improving. So things are starting to pick up in the economy, and probably because we've had such a bad experience over the last 10 years, most people have stopped talking about it. So I think the sectors one should focus on are sectors which have not done so well over the last 4-5 years, and where things are going to improve quite a bit, so we could see big improvement coming in earnings. And that's where some of the things we are focused on, probably amongst our top areas, are corporate banks, capital goods are two areas which are generally very underowned. They've underperformed the market a lot, and that's where we think a lot of the bad news is getting out of the way.
Okay. How would you look at the NBFC space currently, Jyoti?
We've not been very active in the NBFC space since the beginning of the year, which, somewhere probably over the last 3 months has been a good thing, because, we found the valuations quite expensive. So my view would be, even now, I still think corporate banks are probably a space which is going to be more attractive from a pure valuation point of view, and things they are going to turn around. NBFCs probably, they're important. So it's like over the next 3 years, NBFCs will still continue to do well. The next 3 months, 6 months, they'll face a problem of growth because, most NBFCs are restricting growth just so that, they are sure they can refund all the liabilities. So I think, it's a space which is going through a bit of structural change where probably, asset liability mismatches will get, more important for them. There'll probably be some restrictions on the capital which they can keep. So, and once we go beyond that, it is a space which will start to get attractive again. But we've generally, not found the valuations cheap enough yet.
Okay. Jyoti, how real are the concerns around the auto slowdown? Because if you just look at across the board, barring a few odd exceptions like a Bajaj Auto perhaps, it seems looking at the November sales data that there is a trend in place here when it comes to auto sales. Whatever factors you may want to assign to it, that aside, it seems like this is a real problem and the stock prices seem to be indicating very much so.
Yeah, so there is an issue. There is an issue in the short term, and that pertains to the previous question which you asked on the NBFCs. So like I said, NBFCs are going to slow down their lending, and because NBFCs start slow down lending, they were one of the primary lenders which fueled the auto boom. So you're starting to see that more difficulty in funding vehicles, and because of that the demand is starting to slow down. I think this is something which will continue for the next 3-4 months. And just remember, for a lot of the auto stocks, the base numbers are quite high. We had, even in things like trucks which had not slowed down so far, we have a very strong set of numbers last year from November to March. So to that extent, this next 4 months, you'll see even a slowdown in trucks coming through. You're starting to see a slowdown in passenger vehicles. So I think, these are things which will play out. From an investor point of view, from a stock point of view, my thing would be if stocks react very adversely to this, you get stock prices much cheaper. It's an opportunity to buy it because, then once things normalize, growth will start coming back on stream. So we would especially be looking at, weakness in commercial vehicle sales because, that's something which probably next year will do well again as we get into the run up to the BI6 norms.
Okay, Jyoti, we leave it at that. Thanks very much for joining us. In fact, I'm sorry, Jyoti.
Thanks a lot.
I'll hold you on for some more questions. I'm sorry, we still have a little bit of time to go. I wanted to get your quick sense on which are the big risks that can add to the volatility in the markets in 2019. We have a busy calendar. The deal with the OPEC has still been inconclusive. Next week we have the Brexit deal, which Parliament takes up on vote. And then, of course, we have, what Aisha pointed out in terms of the election risk, which you've addressed. But there's so many global factors, and, within all of that, there's also the impending tariff truce, which is in the works between the US and China. Are we bracing ourselves for a very, very uncertain and volatile 2019, more so than what other starts to New Year's have looked like?
Yes, what happens is anytime you look at the market, you can always lay out 8-10 risks. So, when there are risks which we have laid out and we say this is the risk 1, risk 2, risk 3, risk 4, I'm not worried about those risks because to some extent market is anticipating those risks, it is ready for this risk. The main risk which happens is this we didn't anticipate, and that is why, the markets react very badly. It's like 6 months back, if we had thought about this on India, we would probably not have said, a blow up of ILFS would be a big risk. And that is why the market reacted so sharply to it, because it was something which was not coming. So now, to some extent, market is anticipating a risk on Brexit, a risk on, the US-China trade war. So I think those are things which I would not really be very worried about. Maybe, the risk which is really worrisome is Fed hikes too quickly and we end up with a recession in the US. Maybe that's something which the market is not pricing it enough, and that's something which we need to worry about. But otherwise, a lot of these other risks which we have spoken, to some extent market knows about it, it's looking at it. So most of the time the reaction is not going to be very, very adverse. It causes volatility on the way, but ultimately as long as earnings come in, some of these come and some of these go away.
So Jyoti, leave us with some stocks or sectoral themes which you believe investors could look at and make best use of the volatility that the market is going to witness in the next 6 months to buy.
Yeah, so I would say look for stuff which has not really done well over the last few years, where the cycle has been down and where the cycle will turn. So for us, one of the big themes is the corporate banks, which I think will do well, and so that's something you should focus on. On every weakness you should be buying the corporate banks. They come with horrible numbers over the last 3 years, but the next 3 years numbers are going to be good. Second is look at capital goods, especially some of the short-term capital goods, not something which is catering to power generation, but lot of the rest of the stuff. And that is a sector where there's been no capacity adds for the last 10 years, and in spite of private capex being very low, utilization levels are picking up year after year. So again, that's a sector where you will see huge operating leverage coming through. So I would say these are two sectors which are ignored at the market. They've been big underperformers, and that's where you can make good money without having a lot of risk.
Okay, Jyoti, great to have you on the show. Thanks so much for taking the time out and speaking with us.